landlord residential property insurance, and it's more of an overview. Typically, it's what is the insurance company going to pay to replace that property. The second primary component that you want to talk to your investor clients about, which a lot of people may overlook or not really think that much about, is the liability component. Liability, if you've got a tenant with, I don't know, a pit bull. They may be the most adorable pit bull that you know, but you never know what happens when animals are on the property. If your property has a pool and your tenant has weekly parties, having liability coverage is something that is very important to remember and keep in the back of your mind. Property values and liability coverages are two separate things, as most of you may know. But remember that having the liability coverage at the bare minimum really exposes your clients at enormous risk. So you want to be careful about that. Coverage typically is for 1 to 4 units. Anything 5 and above transitions into more of a commercial multifamily type of policy. Landlords can require their tenants, I won't get into landlord-tenant law here, but landlords do have the ability to require their tenants to carry renter's insurance. Much like if you were to go to a strip mall and the anchor tenant is a grocery store, more than likely that landlord is going to require that tenant to carry some form of general liability insurance. So renter's insurance can help to offset some of the liability from the landlord. So that's something else that as a landlord you want to kind of keep in mind, or if you're talking to investor clients who are thinking about purchasing a residential 1 to 4 unit property. Lastly, discounts, very similar to homeowners insurance. Indoor fire sprinkler systems. If there's a pool, having a fence, having it gated is important. Smoke detectors, central fire and burglar alarms, multi-policy discounts will also apply that most carriers will offer nowadays. And second to last, when looking at replacement costs, consider the year of the build, construction type, upgrades for roof, plumbing, electrical, how many stories, attached, detached structures, basements. Those are all factors that go into replacement cost consideration. So basically the takeaway for residential landlord insurance is, again, very similar to HO3, just 1 or 2 endorsements that separate the two. But keep in the back of your mind your replacement costs and liability.
I think there might be a little small mix-up as far as the topic. What I'm gonna do is I'm actually gonna do a follow-up to what Les was doing. I do want to go over basic fire insurance because a lot of times I get a call maybe around 3, 4 o'clock, right before the banks close. They say, "Hey Leon, any fire insurance? My property is closing right now." I'm sure we've all been there. We get those calls, but a lot of times when we get these calls, it's with the client's information as far as the name, their birthday, how much they're buying the property for, and the address. My job as an insurance agent is to make sure, from a basic fire standpoint, we do exact costs on how much we think the replacement cost is going to be. So when we do calculations, it's highly recommended for whether it's real estate agents, title officers, escrow officers. Give us a little breakdown of what you've seen in the home, whether it's granite countertops, hardwood floors. These make a huge difference when it comes back to replacement costs, right, as far as coverage. Great thing that he mentioned was personal liability. When we have a tenant or when you have a landlord who buys a property that's both investment or what it's for themselves, it's highly recommended for personal liability. Liability, it is something that costs extra. It is an endorsement.
Closer to the mic so people can. Thank you.
It is an endorsement, so it does cost a little bit extra. But in the long run, I think we could all agree that we want our customers to keep coming back to us. Our job to protect these clients is to make sure that liability-wise, they do have the protection that's not going to cost them their entire life savings in case something happens, like a pit bull attack or a party. This plays a huge role when it comes to basic fire insurance. I know escrow loves it, and the banks love it, and even customers love it when you can cut costs with fire insurance. One of the main things that I think we could all agree with is that if you want to cut corners with a coffee. Don't go to Starbucks. Spend $10 more with your home insurance, and make sure you have the proper coverage. That's the main thing. Now, as far as all the other endorsement goes, personal property, huge thing with basic fire insurance, whether or not this is a homeowner property or a non-owner occupied property. For basic fire insurance, theft is not covered. I'm sure most of us know that. But when it comes down to it, our clients are gonna get mad. We're the first ones to hear it. You know? Basic things like theft, not covered. This is a fire policy, so things like fire for a coverage A is the only thing that it's the main. It's the main reason why you have this policy. Fire, wind, hail, very basic coverages. I get a lot of times where a customer would call in and say, well, what if an earthquake happens? You know, it's always important to break it down. There's different coverages for certain disasters or catastrophes. So I think that's the main goal what I want to get into here.
I know I've been a
That's too loud.
That's too loud. See? Fortunately, been here for a while, so my mouth gets attached to the mic. I actually had a PowerPoint presentation, but being the senior guy here, I don't know how to do good things, and so we had some problems with the PowerPoint, so I'll just fly off the cuff like I normally do. But if you're a realtor, can you raise your hand if you don't have my brochure so that I can kind of Lee will pass that around real quick. All right, I want to cover, sorry? Yes, Lee's passing it out. What I am speaking about today is the HO6 policy, but really for simplicity term, just think of it as a personal condo policy. And essentially, in the past, how many of you have been realtors over 3 years? Raise your hand. All right. All of you probably remember a time where this was not something that was required. In fact, it was not required. It was just up to the personal individual's choice. The purchaser, when they purchased a condo, they didn't have to buy that. About last year, most banks and all Fannie Mae loans started to require what they call a separate HO6 or a personal condo policy. That's the brochure I gave you folks, so if you could just look at that, and I'm going to take you through that real quick. But what basically happens is in the past, prior, if you had a client, and I'm a realtor here at West San Gabriel, I sold Helen a property, all I would be required to do is to contact whoever the master policy or the association policy was, and that was sufficient enough to close the escrow. Now, if Helen is getting a loan on that property, all right, most of the banks and lenders now are requiring me not only to have that master policy, but to get the HO6 policy. And the way they're having insurance agents, what the requirements is that if she is purchasing a condo, whatever the value of the condo is, they're asking us to put 20% of the purchase price or the appraised value on the dwelling coverage, all right? So in all essence, they're actually forcing Helen to purchase a little bit more coverage than she needs to, but they don't want to go and read each individual CCNRs. Because believe it or not, when you're dealing with condominium complex, we can have 4 condos in a row built by the same builder, but built by different investor, and each condo association can describe what the owner is responsible for. So on this condo, they might say, well, we cover everything up to the drywall, and then everything else, Helen, you're responsible for. That condo might say, well, you know what, we'll cover everything, but once you make a change to the original plans, that falls back into your responsibility, all right? And so some will say, well, we cover everything, but we don't cover the flooring, the cabinetry, the wall hangings. And so it is different. And the reason why this all came about is, well, you know what's happened to our industry in the last couple of years. A lot of foreclosures. When banks started to take all these inventory back of condo policies and they'd get a loss, they were shocked to find out that they were exposed anywhere from $10, $20, $30, $40, $50,000 in structural damages. That's why they came up with this rule, all right? So everybody clear, it's 20%. So if I'm selling her a condo here in San Gabriel for $500,000, I'm gonna be required to put $100,000 in structural in addition to what the master policy has, all right? Super important. Now, let's just look at that you know, a 5-unit condo complex in West San Gabriel, and San Gabriel, I just sold it to her. Unit 3 is what I sold her, that particular unit, all right? Here's what's gonna happen normally. If she had a loss, let's just say she had a fire and it damaged unit 3, all right? They would first go back to the master policy of $2 million, all right? But if they happen not to, if the master policy doesn't happen to cover some of the interior structure, it would fall back to Helen's separate policy, and that's where we would kick in. So the majority of the common walls, or whatever is in the CCNRs, and that's the key, because the CCNRs is what defines what is Helen's responsibility as the purchaser and what isn't, all right? But whatever is her responsibility would be covered by our separate condo policy. Whatever is common area would be covered by the master policy. So everybody has that. Naturally, everybody knows that her personal belongings is never covered by the master policy. It's covered by the separate condo policy. So you might wonder then, why does Helen need to get separate liability policy when the master policy has it? And the problem is if somebody gets hurt around the common areas, it falls back to the master policy. But let's just say that Helen is so excited because I was a fantastic realtor here, and I sold her a $800,000 condo policy, unit for $500,000. So she saved $300,000. She's going to throw a party, and she invites all of you. And unfortunately, you know, they might have an unruly kid, and he's climbing up and down the stairs. And what happens is that his kid hurts himself, separates his shoulder. Unfortunately, Lee forgot to make his medical payments 4 months ago, so he has no medical insurance. Guess who he's going to be going after? Our friend Helen, maybe. Not that Lee would do that, but I'm just using that as an example, and I asked his permission. If it happened within her complex, the master policy is going to say, I'm sorry, Helen, that happened inside your complex, so there's no coverage. So that's why she's exposed from a liability issue. Also, we talked about dogs. Maybe she has a Rottweiler or a Pit Bull that bit somebody, all right? That falls back to her, not to the common master policy, all right? Another thing can happen. She is happy, she's putting out flower pots, you know, up on the second balcony, Lee's walking by from Unit 5, and unfortunately, while she's dancing, she knocks down the flower pot, it knocks him in the head. Again, the liability falls back to her. All right, not to the master policy. So you can see where there's some liability exposures there. Let's just also say that the whole complex got wiped out. You know, anybody remember when that plane came down in Cerritos about 15 years ago? Wiped out a couple of blocks, so it can happen. Well, if the whole complex got wiped out and the master policy only had $2 million in coverage and it cost $2.2 million to rebuild, that $200,000 gets divided by all the owners. That's called loss assessment. That's on this. All right, separate condo policies have something called loss assessment. Unfortunately, if your agents aren't very good, your insurance agents, sometimes they forget to put it in. And many companies only charge $10, $15 for this endorsement. It's very inexpensive. But here's what it does. 200,000 divided by 5 is 40 grand a piece, right? So each one of them, if there were 5 of us owning the complex and the whole place got burned down, and it cost us $2.2 million to rebuild. The association, CCNR, says that we are assessed, each one of us are assessed the proportionate share that the master is going to cover. All right? So each one of us would have to come up with 40 grand. And if Helen did get this policy, then she would be covered under most policies. They give $50,000 of loss assessments. All right? So that's a key. Another thing is, what happens now? Helen just spent everything that she had, and she has no more money, and now she doesn't have a place to stay in. right? It's gonna take anywhere from 6 months to a year possibly to rebuild. So that's called additional living expenses. And what most policies on these HO6 policies do is they'll put either a dollar amount or they'll pay up to 12 months for her to be put someplace else while the whole complex is being rebuilt. Okay? And so that's something important. Now, a lot of people, realtors, and I strongly, every time I do training with realtors, I emphasize this strongly, that when you are in a transaction, whether it be any type of insurance and it's a cash buyer, please, please, please always say that you are going to recommend that they buy insurance, regardless of whether they can afford to have it or not. Because you might be their best friend in saving them money during the transaction, but if somebody gets hurt, and there's a lot of attorneys now attending this board, you'll find how fast they'll find those attorneys to come after you for not recommending that. And as their advisor, they're going to say, well, my realtor said I didn't need insurance. It's all cash deal. That little comment can get you in a world of hurt. So I always tell you guys, someplace in the remarks section on your contract, is that you're recommending it regardless of whether or not they they're a cash buyer. Because here's the conversation I'm going to have. Those that have gone in my training class know that when Helen goes, hey, I'm a cash buyer, and she goes, do I need to buy insurance? I'm going to say, Helen, I recommend that you purchase in this HO6 policy, even though you are not required to do so because there's no loan. All right? So then I write it down on the contract. A year later, Helen has all those losses I talked about, and now she's angry at me as the realtor. Mark, you never told me I needed to buy insurance. Why am I exposed? I thought you said that there was a master policy and it covered everything. Because that word everything in insurance industry is a horrible word for us, because there's no policy that covers everything. All right? So I can bring her back and I can console her, and then I can bring her back to my contract and say, Helen, I'm sorry you have to experience this. I'm sorry you don't have money to get a place to stay. I'm sorry that the association is going to require $40,000 from you to rebuild. But unfortunately, see, back in this contract, although you were a cash buyer and you said you wanted to save money through the transaction of the escrow, I did recommend that you purchase the condo policy. That absolves me. Okay? I wanted to go over a couple of coverage because the guys maybe in their haste didn't allude to what normally is covered under most homeowners, landlords, fire on the structure. You see these items right here? All right? Your covered perils are normally stuff like fire, lightning, wind, hail, freezing, smoke, okay? Theft, some coverages have it, some coverages don't. Explosion, falling objects. Just like if that satellite had hit your house on Friday, all right? That would have been a covered peril, believe it or not, all right? Water damage is one that is very difficult, and it's pretty consistent. In the past, in the industry, many companies were very liberal in their paying the claims. Now, with the tightness of the economy and everybody has to show a profit, they're more stringent to the letter, sort of, that's on the policy. And so the easiest way I always tell clients is, here's how you differentiate when water comes when outside in. And if it's wind-driven rain, it's normally covered. If it hits the ground and comes into the structure, it's not going to be covered. All right? That could be like a flood happening. That could be like sprinklers overrunning and seeping through. All right? A bursted pipe is often something that is covered. That's actually a breakage. So again, Helen's here. Unfortunately, her washing machine pipe's busted. She's going to be most likely covered under most policies. All right? Here's the difference. Helen bought that condo. Unfortunately, it was built in 1926. The shower pan is rotten and all that. She's in it, and all of a sudden, she touches the wall one day, and it's corroded, and it's all rusted and whatnot. Most likely or not, most companies will deny that claim because that's a maintenance issue. But again, I want to thank you for your time. I know that it's a lot crammed up in a nutshell. The guys did a great job, but we're